I will be adding a new company to the portfolio. The company could be seen as a value stock right now. I still think it's one of the biggest brands around the world. Yes, it's true that in the last couple of years, the stock and the company did get hit financially, but also image-wise. So I'll explain throughout the video why I'm making this move right now. It's not your super high growth tech stocks, etc., etc., but I do still think that there is significant growth ahead. I do still think that the brand is worth paying for. And the company is called the Walt Disney Company. At the time of making this video, it's trading at $106.87. It has a market cap of $196 billion and a forward PE of 20 times. As you can see, in the last 3 years, the stock is down 28.7%. In the last 5 years, the stock is down 25%. If we look at what the analysts are expecting this company to do, top line growth wise, not that much growth, right? Mid-single digit growth, but it's all about the bottom line. It's all about Disney becoming more and more profitable. And so throughout the video, I'll explain exactly my reasoning behind. We're going to go over the business segments as well, compare it a little bit to Netflix, and then I'll show you the strength of the, Disney company. If you enjoy this type of videos, hit all the buttons, like, subscribe, do all of that. We really appreciate that. And of course, do share your opinions on Disney. Do you hold it? Did you sell it? Is it on your buy list? Let me know down in the comment section below. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. At the time of making this video, the average analyst price target sits 16.4% higher than the price we're at today. If we're looking at what the analysts are expecting this company to report next quarter, we can see that, huge growth quarter over quarter when it comes to EBIT, GAAP EPS, and non-GAAP EPS. Looking at some pricing metrics, forward PE, EV to EBITDA, price to sales, price to free cash flow, all below the 5-year mean. Price earnings to growth sits at 1.74, not the cheapest one out there, but definitely not the most expensive one either. With regards to free cash flow for fiscal 2025 is expected to come down 12.9%, but then we see growth reaccelerate 15.8% year-over-year growth in fiscal 26, and then another 12.4% in fiscal 2027. Looking at free cash flow, gross profit margin, and all of that throughout the last couple of years, we can see that in the last couple of quarters, gross profit margin and free cash flow margin have started to pick back up. With regards to Disney Plus and Hulu Paid, Hulu did grow in the last couple of years, 71% since the December quarter of 2019. If we look at global Disney Paid subscribers since that quarter, of course, they started quite small. Since then, they've grown around 500%. But of course, it's been since the October quarter of 2022 that, we've been at around the same subscriber amount. Now, more recently, we've actually gotten some more information with regards to the ad-supported tier. So the numbers include an estimated 157 million global users across Disney+, Hulu, and ESPN+. They said the following. At the 5th Annual Tech and Data Showcase at the Consumer Electronics Show, or CES, the president of Global Advertising was sharing that the company's ad-supported monthly active users have reached an estimated 157 million globally, including 112 million domestically on average per month over the last 6 months. Of course, we know that advertising is quite a lucrative business. It basically offers an entry at a lower price, but from a business perspective, of course, advertising, as we've seen with plenty of other companies, it's quite a successful business to have. Now, if we do a quick comparison, Disney, Netflix, of course, streaming business, yes, a bit of the same, but then again, Disney does have the parks, does have a lot of linear stuff, sports. So yeah, there are some differences, but all in all, I think Netflix right now is worth $170 billion more than Disney. There are some reasons for that as well. Although Disney generates more gross profit, Disney's gross profit margin is lower than Netflix. And then when we do the same thing but for free cash flow, Netflix free cash flow margin is close to double that of Disney. But of course, Disney, especially as Disney Plus becomes more and more profitable, that should help free cash flow margin. And Netflix basically showed the world that, streaming can be a highly profitable business if managed correctly. And I think Disney is on the right path. Plus, you've got the parks business, and the parks is quite a lucrative business to own. Now, looking at the different segments of the Walt Disney Company's business, you get entertainment revenue, sports revenue, and experiences. In the last 2 years, entertainment revenue increased by 16.5%, sports basically flat, experiences is up 13.61%. Looking at operating income, it comes at no surprise that, well, the biggest chunk here is still experiences operating income. Then we've got, yes, I know it's quite confusing with the two blues here, but what we've got is, well, here back in October 2022, we've got entertainment that's basically a negative, but that did turn now to over $1 billion last quarter, and actually 2 quarters ago that was $1.2 billion. All in all, despite the wokeism, despite the, well, destruction of, this is subjective of course, but the destruction of Star Wars and maybe the superhero fatigue, overall, if you look at the best global brands in 2024, Disney still sits here at number 16, still in the top 20. Looking at the 2024 worldwide box office, we look at the top 10. We've got 1, 2, 3, 4 Disney-owned movies in the top 10. And you might say, oh, Venom, yeah, but Venom was from Sony Pictures. It's true that it's Marvel, but still, I take here pure non-Sony movies. We've got 4 in the top 10. Then if we look at last quarter, so only Q4, we've had 2 in the top 10. There weren't that many great movies or big movies, to be honest, from Walt Disney. I still have no clue how Wicked is number 1, but then okay. Number 3 and 4, Paramount Pictures actually had quite a good quarter with Gladiator 2 and Sonic the Hedgehog. During the Golden Globes Award ceremony, we've seen that, well, Shogun won 4 awards, The Bear won 1 award, and yes, they are owned by Disney. This is Hulu FX production. Then looking at 2025 and the major releases, this is for movies, not TV shows. For TV shows, there are plenty of other TV shows out there as well, but they're going to come out with, I would say, a couple of big hitters. Then again, the big hitters might also be big losers. I think Disney Snow White is still going to be quite a controversial pick of a movie, but then I think the Fantastic Four, First Steps, I think that's going to be a good entry movie for, well, the next stage of the big Marvel franchise. And then last thing here is basically when you buy the Walt Disney Company, this is everything that you get. You get Marvel, you get 21st Century Fox, which of course they overpaid by quite a lot. You get so many things, Sky PLC, National Geographic Partners. You've got all of these studios, right? All of the parks as well, Disney Music Group, etc., etc. And if you think this is it, no, actually there is way more. Of course, you get ESPN, you get Hulu, and now you get 70% of Fubo TV as well, if the deal, of course, does go through. But you get a huge powerhouse. You get probably one of the biggest and most lucrative IP portfolios on the planet, right? I honestly, I don't know who's, maybe LVMH. Maybe LVMH has a better portfolio, but this is truly remarkable. And then if we do a quick reverse DCF, if we plug in the trailing 12 months free cash flow, yes, I know free cash flow is expected to drop, but we have to plug that in. We can see that to justify today's price, free cash flow will have to grow 5.3% each and every year for the next 10 years to justify today's price. I fully expect Disney to be able to grow free cash flow more than 5.3%. We've seen that it's expected to grow that faster after it drops, but I'm not going to say here, oh, they will be able to grow 12% each year for the next 10 years. Even if we put here 8% or so, and we leave all the rest, of course, this will change, the discount rate and the terminal growth rate will change over time. We can see that the estimated intrinsic value is $132.2, which of course is higher than today. Yes, it's not a 2, 3, 4 bagger or something like that, but I fully expect Disney to become a more profitable business. And when you become more profitable, you will be probably generating more and more free cash flow. Your gross profit margin, your free cash flow margin will go up, and they'll be able to buy back more shares. They'll be able to pay out a better dividend. They'll be able to invest more. Hopefully they stay focused. Yes, for years and years. Maybe they thought they were untouchable. Maybe they had that superhero hype that, well, they thought could last forever. Didn't last forever. I think the marketplace made it quite clear. You make bad content, you are going to get hit. You're going to get hit quite badly, bad reviews, bad financial performances in the box office as well. I think they got the message. I've seen some reports already that they've been making changes inside the House of Mouse. But of course, the big question is going to be who's going to replace Bob Iger, because, well, they are currently looking at a replacement. Is it probably going to be someone from, well, inside Disney, or are they going to take someone from, well, the outside? That remains to be seen, and that's maybe also weighing a little bit on the stock right now. But as of right now, I think the most important part here is that we see a trend when it comes to profitability. When it comes to free cash flow, I think the trend is quite clear. It's going up and to the right, and that's why I'm making that decision to add it to the portfolio. It's also one of the most iconic brands ever created, and I think if well managed, this is one of the must-haves in your portfolio, especially at these prices. That's just my opinion. Now, right now, what we can see is that the stock, well, there was that gap here from last earnings report. This is on the daily. We can see that the 200-day moving average sits at around $102. Are we going to close that gap? Potentially. We can also see that we had a gap down back in May of last year, which we have closed now. Then again, we've seen quite a lot of gaps after the earnings report, right? We've seen one right here, February 2024, big gap up. Of course, that one was closed later in 2024. So yeah, maybe it will go down further, closer to $102. But to be honest, that $4 difference to me does not make that much of a difference. RSI is very low. If we do go to $102, I believe on the daily, we are going to be oversold. And so overall, that's the idea behind me buying Disney. I think the company 2 years ago, 1.5 years ago, I would not have touched it. I think that right now, last couple of quarters, I have seen what I wanted to see. The stock price is not up considerably. Yes, it was lower. Of course, it was under $90, I believe. But back then, I still didn't want to touch it. Now I think just over $100 seems quite okay to me. So that's my explanation. That's my rationale behind it. What do you think? Let me know down in the comment section below. Like, subscribe, do all of that. And I'll see you all in the next one. Bye-bye.